What's up everybody, Gen X Dividend Investor here. In this video I tell you why dividend investors should care about total returns, something that not all dividend investors do. And regardless of what you think about that, please do me a favor and hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Now there are tons of investing styles out there, none of which are objectively right or wrong. One classic breakdown of styles are total return investors on one side, which are people who usually focus on growth stocks, and we have DGI on the other side, aka dividend growth investors, who tend to put more focus on income. Of course, some growth stocks can be dividend stocks, and some dividend investors like me also care about total returns. Let's break down dividend investors a bit more. Some DGIers go for income ETFs like JEPI. Some prefer dividend ETFs like SCHD. Some like to invest in single dividend stocks, and some like to take a more active role and they supplement their income with options. And of course, you can find tons of other approaches and permutations of approaches out there. Any approach can be fine as long as you understand the pros and cons and risks and trade-offs and such. In my experience, the closer dividend investors get to retirement, or towards needing cash, the more they understandably optimize their portfolio towards enabling cash flow, often to the sacrifice of long-term portfolio growth. I mean, it's hard to find assets that have high yield and high growth for extended periods of time, let alone expectations of that continuing into the future. So a common strategy is to first try to get your portfolio as big as possible, and then move into assets that are more cash flowing later in life. Like some people start by investing in things like Google and Amazon and Tesla or whatever, and then once they need the cash, then they sell and move into what will probably be slower growth, but will also yield more cash, such as utilities or income ETFs or etc. And some people just go with dividend stocks their entire investing career. Like some dividend investors choose to focus on their income, even as younger investors, and some are okay to sacrifice some long-term portfolio growth as long as they get the cash flow along the way. Everything has its trade-offs. Optimizing for cash flow when young usually means you may owe more in taxes and you might end up with a lower portfolio value, but the cash flow you get as you go along might reduce your financial stress, and that might be worth doing for you. Just remember that usually the best thing to do is often the harder thing to do in the short term, whether that's eating right or investing or working out or whatever, but making those sacrifices and going down the harder path often makes for a better and brighter future. So if you can afford to sacrifice some income gain now in favor of stock appreciation down the road, then you'll probably end up stronger and less fragile in retirement. Now you might be someone who says you don't care about total returns, but I'll explain why you probably should. So to level set, total stock returns are basically your stock price changes added to your received dividends. Total stock return is considered a strong measure of an investment's overall performance. A return is called realized if you achieved it. So getting dividends are realized, whereas your stock price changes are only realized once you sell. That means that before you sell, your gains and or losses are considered unrealized. I'll give you an example. If you bought 10 grand of J&J and it's now worth 12 grand because the stock price went up 20% and you're still holding it all, and if J&J had paid you $500 cash of dividends along the way, then your total return would be $2,500, i.e. $2,000 of unrealized gains from the stock price going up, combined with $500 of realized gains from the dividends. If you sell all your J&J stock, then you'd have $2,500 of realized total stock returns. Some people only think about realized gains when they say total returns, whereas others include the unrealized portion when they're talking about total returns. And that brings me to something that Warren Buffett, arguably the best investor of all time, once said, which was, "By far, the best book on investing ever written is The Intelligent Investor." It was written by Benjamin Graham, aka the father of value investing, and was Buffett's professor at Columbia Business School in 1951. Buffett said that of all the investments I ever made, buying Ben's book was the best, except for my purchase of 2 marriage licenses. In his 2013 Berkshire Hathaway shareholder letter, Buffett wrote, "My financial life changed with that purchase," aka buying Graham's book. And he wrote that picking up that book was one of the luckiest moments in my life. I say all that because it's one of the books I keep by my bedstand and because I found it to be an easy and extremely valuable read for anyone who wants to become a better investor. And selfishly speaking, I have an Amazon affiliate link in the description of this video for The Intelligent Investor that you can click on to order the book. As an Amazon associate, I earn from qualifying purchases, so it's a free way you can give me a commission from your purchase without it impacting your price. But honestly, what matters more to me than you using my affiliate link is for you to read the book. I want to quote a few of my favorite passages from it. Here's the first one. Basically, price fluctuations have only one significant meaning for the true investor. They provide him with an opportunity to buy wisely when prices fall sharply, and to sell wisely when they advance a great deal. At other times, he will do better if he forgets about the stock market and pays attention to his dividend returns and to the operating results of his companies. So what does that mean? Well, you should get excited when stocks crash, since it gives you an opportunity to acquire assets on the cheap. And you should focus on your dividend returns to keep you happy if a crashing market bothers you too much. Another great blurb in the book is in the chapter about how to analyze a stock, where Graham talks about some of the considerations you should use. He said you should understand a company's long-term prospects, its management, its financial strength, capital structure, and its dividend record. In fact, he wrote, one of the most persuasive tests of high quality is an uninterrupted record of dividend payments going back over many years. And then he said that a company that had that kind of record was regarded as entitled to a higher multiple. I'm curious, do you think that means that a quality dividend does add value to a company's stock price? If so, then how does that relate to the core tenet of the dividend irrelevancy theorem, which suggests that a company's dividend payments don't add value to a company's stock price, and in fact that dividends hurt a company, since the money would be better reinvested in the company? Regardless of what you think, you shouldn't buy a company just because it has a dividend, and a company that pays a dividend isn't automatically a better company. Though I do think it's reasonable to say that companies with a solid track record of paying dividends tend to come from better quality companies. But it doesn't mean you can't find great companies that don't pay dividends. Bottom line, you always want to invest in quality companies, and it's fine if you prefer to focus on quality companies that have great dividend track records. Graham also said that the real money in investing will have to be made, as most of it has in the past, not out of buying and selling, but out of owning and holding securities, receiving interest in dividends, and benefiting from their long-term increase in value. Nice. And then another interesting blurb was in the chapter about shareholders and management, where Graham wrote about the most important ways that management may fail to act in the best interest of shareholders, and the first he listed was a failure to pay dividends commensurate both with earnings and with the value of stockholders' equity. He followed on saying, there is no truth more fundamental in investment than the simple statement that dividends and market value are the only concrete returns which a public shareholder ever gets for the money he puts into a company. And then in the margin of safety chapter, Graham wrote that the market has a stubborn habit of valuing earnings dispersed in dividends more generously than the portion retained in the business. Sounds like dividends matter, don't you think? And for the people who say that they don't invest in dividends because all that happens is that the stock price falls when dividends are paid out, well, let me quote Investopedia. Studies show that stocks that pay dividends, like many established companies called blue chip stocks, often increase in price by the amount of the dividend as the book closure date approaches. Although the stock can decline once the dividend has been paid, many dividend-seeking investors hold these stocks for the constant dividends they offer, which creates an underlying level of demand. And they said, the declaration of a dividend naturally encourages investors to purchase stock. Because investors know that they will receive a dividend if they purchase the stock before the ex-dividend date, they are willing to pay a premium. This causes the price of the stock to increase in the days leading up to the ex-dividend date. In general, the increase is about equal to the amount of the dividend, but the actual price change is based on market activity and not determined by any governing entity. Get it? Let me restate that so it sinks in. Dividend stock prices often get pushed up due to buying at an amount that is roughly equal to how much the stock price gets pushed down due to the dividend payout, apparently due to market dynamics and psychology. And that makes sense. I mean, if a company has a history of paying a dividend and the market feels that the company will continue to generate enough cash flow to keep paying one, then knowing stock prices drop by the dividends seems to cause enough extra buying to prop it up beforehand to ultimately cancel things out. Now, that doesn't mean a dividend is free money. When companies pay a dividend, it normally lowers the cash on their balance sheet, and thus it lowers the equity value of the company. And market psychology gets even more complicated when we're talking about one-time big dividend payouts, to the point that you can't game the market and consistently predict things. So I think you'd be being a bit myopic if you don't invest in dividends because of what happens on the X date. Maybe you still think that dividends are irrelevant, useless, and potentially harmful. As long as you invest and you find a way to retire early if you want, and you have your own ability to manufacture income streams, then do whatever floats your boat. That being said, if you are stressed about your finances and are worried about how you don't have enough savings and you have no idea if you'll ever retire, but the idea of a pension-like income stream that tends to grow over time sounds appealing, then I suggest looking into good dividend stocks as part of your overall strategy. It's not a guarantee, nor is it risk-free, but nothing is in life. I've now been living on my dividends for almost 2 years as they pay all my bills, like my health insurance and my mortgage and my gas and food and etc. And even with spending most of my dividends, my portfolio is near all-time highs in this down market, and I'd actually be at a new all-time peak if I hadn't been using my dividends. Dividends don't work, you think? Fascinating. Okay, with that out of the way, let's dive into why dividend investors who ignore total returns may be on a less sustainable path than those who factor total return potential into their portfolio. That doesn't mean total returns has to be your only focus, nor does it mean it has to weight everything in a yes-no fashion based on it or something, but I do think that when looking at your portfolio in aggregate, you'll find that a more sustainable and powerful portfolio will be one that grows over time. Why does it tend to be less sustainable? Well, over time, things like inflation take a bigger piece of the pie if there isn't growth. Your amount of capital grows slower relative to a portfolio that was also built for total returns, which usually translates into a slower growing income stream. That doesn't mean right away, nor does it mean that'll be true in every case. My point is you want to look at trends over time, and a strategy where your capital isn't growing much will probably lead to a stunted income over time. So while you might be someone who doesn't care about total returns, your income probably will be something that cares about it. Okay, so why else do total returns matter? Well, the larger your portfolio, the more power and flexibility you have. For example, just like a bank can lend you money against the equity of your home, your brokerage firm can lend you money against the value of your portfolio. I don't think you want to do that, but the option nonetheless is powerful. I mean, if a dire emergency crops up and you don't have the cash set aside to cover it, then you could always sell stocks. That's even okay if your strategy is to buy and hold forever. Having the option to deviate makes you less fragile. It makes you financially flexible. I dated a girl in college who was super flexible, but not very financially flexible. I'll tell you that story on my other channel, Gen X After Dark. Anyways, optionality in your finances makes you able to respond better to bad and unexpected situations. The more capital you have at your disposal, the greater your response potential and ability to recover and flourish. A larger portfolio lets you have more dividend investments that can grow, rather than simply high-yield ones with little to no growth. Like I have Apple and Microsoft as my two largest positions in my dividend portfolio because my overall dividend income, including those, is enough to cover my expenses. Thus, I don't need to sacrifice their low yield but higher growth, and instead only have higher yield stuff with less growth. But to be crystal clear, there are an infinite number of paths you can take financially to hit whatever goals you want, and if your goals go in a different direction than mine, then don't fret. You might need to target higher yield things to hit your goals, and as long as you're aware of the trade-offs and pros and cons and risks, then that puts you ahead of 99% of the people out there who either don't invest or invest blindly and are unaware. If you have a long-term investment horizon and plan on holding a portfolio for a long time, it makes more sense to ensure total return is part of what you build for. Everything depends on your individual needs and goals and risk tolerances, which tie to your circumstances and investment horizon. I propose that for dividend investors, it is generally wiser to consider both total returns and income when selecting an investment, ideally in relation to all your other investments. Let's look at a recent example of a stock price appreciation and dividends as part of returns. Here's a graph for the last 20 years done by Refinitiv that shows a hypothetical $10,000 investment in the S&P 500 comparing price appreciation versus total returns, which includes reinvesting dividends. What we see is that your 10K would have had a 6.94% annualized return when looking just at price appreciation of the S&P 500 over that time, or you would have had a 9.08% annualized return if you had been reinvesting your dividends. Building portfolios for both income and total returns makes most sense to me, and then you can decide if you want more total returns or more income and then adjust accordingly. Here's an example by Bespoke of the S&P 500 total returns versus price returns from 1990 until 2015. What you see is that the S&P 500 has gone up 517% over that time frame, but if you had been reinvesting your dividends, you would have almost doubled your return to 989%. Compounding is amazing. A key takeaway for you is that dividends have a significant impact on your stock portfolio's performance. Dividend-paying stocks tend to outperform non-dividend-paying stocks over long periods of time. But there are no guarantees with dividends or with any investment, and past performance doesn't guarantee future performance. Tougher markets like the ones we're in lately are the ones where dividends often shine. Of course, when the S really hits the fan, everything seems to fall, dividends or not. But I'll still invest with a nod toward dividend passive income. I love getting cash and doing nothing. A Patreon aristocrat of mine on my Dividend Discord chat server recently asked how much dividend income my portfolio produced while I was on vacation. The answer was $1,550.77 of dividends were auto-deposited into my checking account while me and my family were on vacation in Europe. How awesome is that? I mean, here I am, leading my family through Europe, appreciating the amazing architecture and history and food and such, And meanwhile, my businesses, which employ millions around the world and which are selling products and services that people want, sent me $1,550 for their profits since I'm an owner. I didn't have to talk to anyone, I didn't have to work on my computer, I didn't have to deal with a property manager or a broken AC unit. The cash just flows into my bank account via an auto deposit from my brokerage. I don't say any of that to brag, but instead to help give you motivation to invest as well as conviction to continue to invest when times are tough. It doesn't matter if you start small. Pretty much everyone starts small. So start, don't quit, and grow. Don't compare yourself to me, as it's immaterial who I am and what I do. What matters is if you are putting yourself on a better financial path. Anyways, speaking of vacations in Europe, well, I have subscribers from around the world, so let me show you an example I've never done before, which helps highlight how powerful dividends are using the FTSE 100, aka the largest 100 companies listed on the London Stock Exchange. Today on August 16th, when I'm doing this part of the video, the FTSE is at 7536. On December 30th, 1999, before the dot-com crash, the FTSE was at 6930. What we see in this graph is that the FTSE did nothing for over 20 years. That's not just a lost decade, that's more than 2 decades where it took to get back to its previous peak. And I'm not even factoring how inflation further ate away at things for those 22 years. I mean, think if you were someone who didn't have dividend stocks and you were selling 4% of your portfolio each year to pay for your expenses. How crappy would that be? Are you sure you don't want cash flowing dividends growing in your pocket as the decades go on? Barclays in England released a study in 2019 that showed the performance of £100 invested into cash versus bonds, which they call gilts, versus stocks between 1899 and 2018. £100 back then would be worth around £12,000 in 2018 thanks to inflation. If invested in gilts, that same £100 would be worth £42,000. However, £100 invested in British equities in 1899 would now be worth around £2.7 million, assuming you had been reinvesting dividends. Yummy. Now, I've shown you multiple studies that show how dividend payers tend to outperform non-dividend payers over broad periods in history. Well, I found another study that concluded the same thing. Wellington Management recently conducted an analysis of the S&P 500 from 1930 to 2019. They began by dividing companies into quintiles according to their level of dividend payouts. The first quintile, i.e. the top 20%, comprised the highest dividend payers, while the bottom quintile comprised the lowest payers. As the table below reveals, the study found an unambiguous correlation between those paying dividends with the ability to beat the index overall in each of the 9 decades they analyzed. So what do you take away from all this? Well, the most important thing is to hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Okay, now I'd like to call out the Patreon aristocrat who joined since my last video. So thank you Loudy Dowdy for signing up. Aristocrats gain access to my Dividend spreadsheet product that I use in my videos, and they get to be in multiple private channels on my Dividend Discord chat server, where I let my upper tier Patreons watch my videos before I release them publicly on YouTube, as well as they get to vote on which thumbnails I use on my videos, and of course they get more direct access to me. Finally, I highly recommend that you join my free Dividend Discord chat server, which has thousands of dividend investors on it and it's growing all the time. Thanks for watching, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.